Walgreens just reported it skyrocketed after hours, before hours, pre-market. Market opened. The market was crashing beforehand, down 3%. Walgreens went down, and then the market rebounded. You remember that whipsaw day? I think it only happened like 5 times in history or something crazy. Now, here's what Walgreens reported. They recorded a fourth quarter loss from continuing operations of 48 cents, which is a decrease of 89 cents from a year ago, but adjusted earnings per share decreased 31.8% to 80 cents. So there was some costs in here that they threw in there. Now, remember, the COVID-19 vaccination volumes has decreased significantly. That is why their sales are down. And I understand that completely. But there are strong tailwinds for the company. They're expected right here, raising U.S. healthcare fiscal 2025 sales target. They raised from $11 billion to $12 billion. And they're expecting full year fiscal 2022 earnings per share was $5.01, an increase of 117.6% compared to a year ago. So even though this quarter was bad, the full year was still much better. For next year, they're expecting EPS of $4.45 to $4.65 because of strong business core growth. Now remember, more as time goes on, the COVID revenue and profit is going to fall off. And this is something we've seen a lot of. So let's go take a look at Walgreens in our software to determine what we would like to pay for Walgreens. So Walgreens is currently at $34. In the last year, it had a high of 55 and a low of 30. And that 30 was just recently before it jumped up. Now, before we go into 8 pillars, look at this, guys. Big dividend yield of 5.7% that pays out $1.7 billion. But look at this. The thing I like is their average 5-year free cash flow is $4.25 billion, easily afforded. With that said, their last 12 months of free cash flow is only $2.17 billion. So that eats up a big chunk of their free cash flow. Okay, so that's something to keep in mind. So our 8 pillars. First one, 5-year PE under 22.5. Go here to the left. It's 9. All right, check mark there. Last year's PE, 7, not even, 6.8. Pillar number 2, we want the 5-year return on invested capital being greater than 9%. Go here to the right, it's poop, 6.5%, okay? So what does this mean? It means we got to pay a cheap price for Walgreens. When you don't have opportunities to reinvest your capital at higher rates of return, you just got to pay a cheap price for Walgreens. So we're going to use a lower multiple and a higher discount rate, a higher desired annual return when we do the stock analyzer tool at the end of this video to determine what price to pay. Pillar number 3, simply, we want revenue growth. Income statement, 5 years ago, 131.5, last year 132.7. Barely any revenue growth, but it's there nonetheless. Pillar number 4, we want net income growth. Scroll down to the bottom, right here, 5 years ago, $5 billion, last year 4.34. X there. So guys, so far we have a few X's, a few checks. All right, it's kind of a mix going on here. So pillar number 5 is the silent killer investing. We want shares outstanding staying the same or decreasing. Now this company is selling for 9 times 5 years profit and 7 times last year's profit. So relatively, it's very cheap. We want the company buying back shares, not issuing shares when it's very cheap. So you scroll on the bottom. We go back to the end of the 6th year, 1.06 billion to 860 million. Check mark. They've decreased their shares by about 20%, okay? Now, this is good because now if you own a share of the stock and they keep buying back more shares, you still keep that same ownership of stock, but now the revenue and profit, you're getting a bigger piece of it as time goes on. The opposite occurs when they're issuing shares. You're getting less and less of the shares of the revenue, profit, and free cash flow. So we want to make sure that especially inexpensive companies are buying back shares. So we have that here. Pillar number 6 has to do with long-term liabilities, okay? Now, long-term liabilities work the same for a company as it does for you. The more debt it has, the harder it is when times are tough, okay? So what's a reasonable amount of long-term liabilities? So we go back to the main page. We look at the 5-year. What I've determined for myself is I look at the 5-year average free cash flow, 4.25, and I multiply it by 5. That is $21.25 billion. We want their long-term liabilities under 21.25. Now, I want you to keep in mind, Walgreens has a lot of locations and their leases will probably appear in the long-term liabilities. So it's probably going to be high. We go to the balance sheet. We go to the bottom, current liabilities of $37 billion. That's a lot. Long-term capital lease obligations is $32 billion of that. So I'm not as worried about this as other people would. We wanted it to be under 21 billion. It was 37. For retail, I think it's more understandable, and Walgreens tends to have great locations, okay? Now, pillars 7 and 8 have to do with free cash flow. Free cash flow is cash from operations less your capital expenditures. And the 5 things you can do with free cash flow are buy back shares, pay a dividend, pay down debt, reinvest back in yourself, and make acquisitions, okay? Now, they can do any of those. They can do none of them, whatever they want to do. But you see here, they pay dividends. They're buying back shares. I don't know what the debt levels. The debt levels are coming down a little bit. Well, the debt levels are about the same. So they're still in growth mode. As the U.S. economy shifts to more growing markets, they're going to have more opportunity for growth. They'll probably close stores that aren't performing very well in the North and Northeast and open more stores in the South as the population shifts there. Also, I was just in Europe. I was in London, and I saw the Boots pharmacy. I loved it. I thought it was beautiful. I thought it was great. It was very clean, had better selections. It was funny because I was walking. I'm like, oh, Boots from Walgreens Boots. Let's go in here. And I literally went and bought, what was it? My fiance needed a pair of socks because her feet were killing her in her shoes. So we bought it there. All right, so let's look at their free cash flow here, right down here. So 5 years ago, 6.9 billion. Last year, 2.17. Definite decline. I don't like the cash from operations declining so much. So this is immediately a red flag for me. What is going on here? Why is it declining so much? Now, into full disclosure, I have shares of Walgreens. That does not mean you should go out and buy Walgreens. I'm hoping that because it's so cheap, they can buy back shares, and in a long period of time, I'll be able to get a decent return. But this is what happens. The stock falls a lot. It's a good time to sit there and say, wait a second, what am I missing here? So that's what I'm doing here with this video. I'm sitting here from a 500-foot view looking at it going, okay, what's going on? Now, finally, our last metric, we want to take their 5-year average free cash flow, and we want to use it to come up with a market cap for the business we pay for it, just like we did with PE. So 4.25 times 22.5 equals 85 plus 8.5 plus 2. So that is $95 billion. So we basically want a $95 billion market cap. What's the current market cap of Walgreens? Holy Toledo, it's $30 billion. And that makes sense with how cheap the company is in terms of PE and price to free cash flow. So does this mean you should go out and buy the company? Again, pump the brakes. Here's the 8 pillars. There are X's here that you have to understand. I'm not as worried about this one. To me, it just says, Paul, go pay a cheap price for the company. This and this are what concern me the most. I want to figure out why is their net income and cash flow going down, even with revenue going up. So let's see what analysts are saying here. On our software, there's 20 analysts, and they're calling for a drop in revenue, drop in earnings per share over the next 5 years. In terms of revenue, they are calling for increases, but not much. Guys, this is a huge company. They're international. They're ginormous. It's going to be hard for this company to grow. So you have to pay a cheap price. So they buy back shares and you get your dividends there and they pay down debt. That's how you're going to get your return on Walgreens. Okay. Now, one of the things I also want to do that I don't do much in this show, I want to sit there and look at their 10K real quick. So on our main page, on the metrics page, I go to the bottom and hit annual reports. I'm going to go to 10K and hit it right here. It just came out last week. So what I want to do is I want to look at comparable sales of stores. Here's what I like. Boom. 2.8, 5.1, 5.1. What does this mean? That means the stores that have been open for whatever they determine their comparable stores is set to be. Let's see. They'll announce it here at the bottom. Comparable store sales are defined as sales from stores that have been open for at least 12 consecutive months without closure for 7 or more consecutive days, including due to looting, blah, blah, blah. So that's how they explain it right here. So the company's stores that have been open have pretty solid same-store sales growth, okay? I like this. This is a good sign. Now, the other thing I want to do, gross margin, increasing. I like that. Now, granted, their selling and their SG&A expenses are increasing at a higher rate. So this is the stuff you can find in the 10K. I'm not doing my deep dive in the 10K, but these are the things I'm looking at. One of the other things I want to look at is opening. Let's see. Let's see how many stores are opening. As of August 31st, 2022, the company has closed 235 and 287 stores in the UK and US respectively. Right here, though, divisional optimization within the company segment includes activities such as optimization of stores, including plans to close approximately 350 stores in the UK and 450 to 500 stores in the US. So there are plans to close a lot of stores, be more efficient. When they made acquisitions, there's probably some overlap. So there's going to be decrease in sales because that's a lot of stores, guys. How many total stores do they have? I don't even know. So in their 10K, I found here, U.S. retail pharmacy, international, U.S. healthcare standalone clinics. This is what we have. There's a lot of locations here, 13,340 total locations. So closing 500 in the U.S. and whatever the number was in UK only closes about 5 or 6% of their total stores. But still, it's about becoming more and more efficient. And that's the key here. So I like seeing these things. Again, let's go back to the software and see what's the good price to pay for the company. So I'm going to be very conservative here. Their revenue growth of the last 10 years is 7% here, but that's probably because of their acquisitions. It's not because look at 5 years and 1 year. It's not high. So I'm going to go -1, 0, and 1%. Yes, that's conservative. Profit margin. Now, I do think their profit margin will increase as they start expanding into more than just the drugstore environment, start doing more clinics and things like that. But let's do 2.5, 3, and 3.5. Free cash flow, I'm going to do the exact same thing. PE. Guys, I'm going to go with 8, 11, 8, 10, and 12. Sorry. And same with price to free cash flow because this company doesn't have a high return on invested capital. It's not growing a ton. I need to make my money by buying it cheap. That is key here. What happens usually is people overpay for growth and underpay for lack of growth. I want to pay a reasonable amount of money. All right. Now, finally, desired annual return. As my assumptions get larger, and as I get more and more concerned about what I don't know, I want to put a higher desired return. Because remember, you can get 9 or 10% by investing in a long-term ETF. So if you're trying to get 10% here, just buy a long-term ETF. So for this one, I'm going to do 12, 13, and 14% because this is a very large company. I'd be very, very shocked if Walgreens went away in the next 5 or 10 years. I'd be like, what happened in this world that caused Walgreens to go away? So I'm hit the analyze button. It's currently at $34 a share. There are going to be 6 numbers that pop up. 3 based on low, middle, and high for earnings, and 3 based on low, middle, and high for free cash flow. If they're all green, it doesn't mean go out and buy. It means go verify this data. Make sure you're right. Go do your research on the internet. Go find the bull and bear case of the company. Or very simply, join our community. Everythingmoney.com. Join. You get all the software in the community to have conversations with other investors about it. This is the most important part. Please don't go to message boards and chat boards where there's a bunch of keyboard warriors saying negative things. Go do unbiased research. Go find the unbiased people out there that are commenting on this company. So I hit the analyze button. Boom. Low price of 30, high price of 48, mid price of 38. So based on this, it's looking like a buy. Again, do not go out and buy. I am still selling puts on this company at much lower prices. It's on my watch list now at 30 because it kept hitting my prices. Again, always do your own research. Never buy because of what I say. And this price, I'm just selling more and more puts to generate income and buy this company at lower prices. This is a really, really good video, but I need you to watch the next video on the 3 keys to being a successful investor. That's mentality, emotion, and process. Thank you very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?